Hey Bowtie Nation, Joseph Oak with an update to one of the most popular videos on the channel, and without a doubt, the easiest dividend portfolio you will ever see. Just 4 monthly dividend stocks that will pay you an average 12% dividend and put that cash in your pocket every single week. I want to get started on our list, but stick around and I'm going to show you how easy this is to set up, secure that weekly cash flow, and then show you all the monthly dividend stocks and when they pay out. First up, one all you citizens of the Bowtie Nation are going to recognize, Main Street Capital, ticker MAIN, with its 8.3% yield. And I know it's not a high yield stock. In fact, it's the lowest dividend yield on the list, but looking at the list of monthly stocks and which weeks they pay out later, we don't have much of a choice here. That's because how we're setting up our portfolio for that weekly cash flow. I'm going to walk you through exactly how to do this next, but we can see here, shares of Main Street go ex-dividend in that first week of each month. So buying this stock sets us up to receive that dividend about 2 weeks later on the payment date. When I show you that full list of all the dividend stocks, you're going to see we don't have much of a choice for this first week's dividends. In fact, there are only 3 monthly dividend stocks that go ex-dividend in this first week, and Main Street offers the highest yield. But I'm also going to show you how to get higher yields, an update to this portfolio that you can use to get dividends of 11 to 17%. Now that said, even though Main Street only pays an 8% dividend, it's still one of the best monthly dividend stocks in my book for its price return. You can see here against other BDCs in the VanEck BDC Income ETF, the BIZD, Main Street has outperformed it by 21% in the last 2 years. Shares of Main Street have produced a total return of 71% or 11.3% annually over the last 5, so that is a solid price return on top of the dividend you collect each month. Main Street is also one of the most consistent and dependable monthly paying stocks. The dividend hasn't been cut in the last 5 years and has grown at a steady 3% pace. As a business development corporation, a BDC, Main Street specializes in loans and equity investments into mid-sized businesses. The company had 182 portfolio investments as of the first quarter, with the largest representing just 3% of the total fair value. So a hit to any of these investments isn't going to hurt their stock that much. And a big part of why Main Street has been one of my favorite monthly dividend stocks is the yield it collects on its loans is so much higher than that dividend yield. With an average yield on its portfolio over 12%, it's collecting more than enough to pay that 8% dividend and still reinvest in the business for growth. Now, all this means not only dividend safety, but also that stock price return. We're just getting started on our dividend list, but just as important as those 4 stocks is how this is going to work. You know, I'm not about to just drop a list of stocks in your lap and say, go buy these. I want you to understand how this works, to be a better investor and be able to take control of your portfolio. In this video, I'm highlighting my favorite monthly dividend stocks on our list, but I wanted to show you how to put this together so you can recreate it if you need to. It is super easy. It's just search for any monthly dividend stock here in Yahoo and go to the historical data tab. Here we'll change the time period to 5 years and to show dividends only and click apply. That's going to show you the ex-dividend dates for the stock for every dividend back 5 years. As an example here, you can see that Global Water Resources tends to go ex-dividend in the 3rd week of the month, usually between the 14th and the 16th. From there, it's just a matter of writing down when each monthly dividend stock goes ex-dividend, which week of the month. Another popular one here, for example, Realty Income tends to go ex-dividend in the last week between the 28th and the 31st of the month. Now, one thing to remember here, that ex-dividend date is different from the day you're actually going to get that dividend. The ex-dividend date is the first day the stock trades without the dividend. Now, listen to that again because it is hugely important. If you buy the stock on the ex-dividend date or later, you're not going to get that dividend, that recent dividend, and not going to get a dividend until the next one comes around in the next month. You need to buy and hold these before that ex-dividend date. The payment date, the day you actually see the dividend hit your account, is usually a week or 2 after that ex-dividend date, but planning our dividend stocks like this, with this staggered approach where we have at least 1 monthly dividend stock going ex-dividend each week, you're going to end up getting that dividend payment every week as well. So for you long-term investors, the difference between the ex-dividend date and the payment date isn't going to matter much. You're going to own those dividend stocks for months and will get that cash payout every month for each. Our highest yielding stock, Armor Residential, ticker ARR, with a 15.2% dividend, has had an absolutely horrid price return over the past 5 years. But I'm going to show you later how to turn this into your advantage. It's going to fix one of the biggest problems for growth stock investors and create what could be the perfect portfolio. Shares here are down almost 80% over the last 5 years. But to understand why here and why it might be a good time to start buying, understand that Armor is a mortgage REIT, an IMREIT that borrows on short-term rates to invest in long-term mortgages. In a normal economy, that's a great deal as the company pays back that borrowed money on lower short-term interest rates and collects much more on those rates for longer-term loans, as shown here in the normal yield curve. But that normal environment has been turned on its head over the last few years, with short-term rates much higher than the long-term rates. And that means the spread, or the difference between the rates MREITs collect on those mortgage investments and the rates they have to pay on that borrowed money, has evaporated. ARMOR carries a portfolio over $8 billion in residential loans and treasuries on which it earns interest, but the profitability on these is at historic lows. But then what the Fed has destroyed in its fastest rate hikes in 40 years could soon become a tailwind for MREITs like ARMOR. Inflation is still above the central bank's target, and we've continuously had to push back our expectations for rate cuts, but those cuts will happen, most likely later this year. When that happens, you're going to see a reversal of that pain in the mortgage market. You'll see mortgage rates start to come down from that peak near 8% last year, closer to 5%, which is going to drive home purchases. And more importantly for MREITs, you're going to see short-term rates in that yield curve come down faster than those longer-term rates. That's because the Fed has a direct impact on short-term rates, while long-term rates are more a function of the economy, so we could very quickly get back to that normal upward sloping rate curve. And here, I'm sorry to go all economics nerd on you, but it is important when investing in these MREITs like ARMOR Residential, and to know that now, before those rate cuts start, it could be the best time to buy, because once those cuts happen, it could be a massive tailwind to the stock, pushing that price higher, along with the 15% dividend yield. For our weekly dividend portfolio, we can see shares of ARR typically go ex-dividend in the second week of each month. We're halfway through our weekly dividend stocks portfolio, but I want to make sure you understand the risks in monthly dividend stocks, and one way to combine these with your other stocks that could create the perfect portfolio and save you thousands of dollars on your taxes. Nation, the biggest risk in monthly dividend stocks is that most of these pay out almost all of their profits in dividends. In fact, the business development corporations, those BDCs like Main Street and Horizon Technology, get a special tax break if they pass through all their profits to investors. And while this creates huge dividend yields, it creates a bigger problem that the stock price doesn't grow as much, if any. I researched the highest yielding monthly dividend stocks in a recent video, and you can see here in the fourth column, 4 of the 7 stocks saw their prices fall over the last 5 years. And these were some of the best I could find. Most monthly payers see significant price destruction over time because the companies just aren't keeping any of their profits back for growth. And the fact that they pass most of their profits through to investors also means the companies have to constantly be raising funds through debt or share issuance to fund those new loans and their growth. That can be another problem when interest rates increase, so you see a lot of volatility and further price declines in these stocks. And that's why recent news that Aflac and other insurers are starting to invest in these private credit BDC type businesses is so important, because it could plug that funding gap many of them see and help support loan growth. But I want to show you how you can take that biggest problem for investors in monthly dividend stocks and turn it to your benefit by combining these stocks with a portfolio of high growth tech stocks. Here I'm talking about those fast-growing AI stocks and internet names that may not pay a dividend, but have the potential to 10x your portfolio in just a few years. For example, if you had invested $10,000 in shares of NVIDIA 5 years ago at $41 each, you'd be rich as f*** right now with $278,000 in the stock, but would also be sitting on a tax bill of $40,000 if you ever take any of those profits. But combined with a few of these monthly dividend stocks, not only do you get that weekly cash flow, but it's also going to cut those taxes big time. Using our example, if you had invested $20,000 into shares of ARMOR Residential 5 years ago, you would have collected that double-digit dividend every month, but would be sitting on a capital loss of almost $16,000 on the share price. Selling those shares in the same year that you sell some of your NVIDIA is going to lower your tax bill by more than $2,000. That's because your profits and losses on stocks get added against each other each year, so the loss on your ARMOR share price is going to help offset that giant gain on NVIDIA, and you still collect those monthly dividends. This is why it is so crazy when I see dividend investors stay almost exclusively in dividend stocks, and growth investors avoid dividends. Putting these two ideas together creates a portfolio that not only pays you that constant cash flow, builds your overall wealth faster, and saves you thousands come tax time. Pennant Park Floating Rate Capital, ticker PFLT, made another dividend list recently with its 10.8% yield and strong overall return. Pennant is another BDC but specializes in floating rate loans, a unique advantage it's had over other BDCs in the last few years. 86% of the portfolio is in secured debt on first liens with another 14% in equity investment to give it even more upside growth. And that high percentage of loans with first lien status is going to help protect it from a downturn in the economy, while the high equity position will help it rebound later. The company's current portfolio of 141 companies is diversified across more than 30 industries, with an average loan size around $9 million. The 10% average portfolio yield isn't as high a spread over the dividend as I'd like to see, but this company has a history of performance. That first lien status and floating rate, along with the diversification, has helped it double the dividend since 2011, the kind of growth that's hard to come by in volatile BDCs and monthly dividend payers. PennantPark has grown the dividend at a slower 8% pace over the last 5 years, but has managed to keep that stock price relatively unchanged. Again, that's rarer than you might expect with these high-yield stocks. For our weekly dividend plan, you can see PFLT goes ex-dividend right on the edge between the second and the third week of the month, so you're probably going to receive those dividends closer together, but I'm going to show you some other monthly payers in our complete list later if you want to put some time between your dividend checks. I'll reveal our fourth monthly dividend payer and the entire list of monthly stocks next, and while I love this monthly dividend stock portfolio for its simplicity, I would never recommend putting all your money in just 4 names. To get you started on a more complete dividend portfolio, I'm going to link to some of the most important videos in the description, or check out this video next, my top pick for dividend stocks this year, the one I'm buying above all the rest. Prospect Capital, ticker PSEC, hasn't done as well as Main Street on price returns, with the share price down 13% over the past 5 years, but makes up for it with a much higher 13.8% dividend yield. So even despite that drop in the shares, the stock has produced an 8.5% total return annually over the 5 years, and we see how we can use that loss on price to your advantage. Prospect is another business development corporation that BDC founded in 2004 with over 16 years of dividends and performance. The company manages an $8 billion portfolio of 122 investments in companies across 36 industries and earns a 10.1% yield on its portfolio. That's also quite a bit below the dividend yield, but the company has been able to manage it to keep those dividend payments over the last 5 years. Prospect has been able to pay out nearly $21 per share in dividends, more than $4.2 billion since its IPO. And if your only focus is on that dividend cash flow, you might take another look at this stock. Here's that full list of 30 monthly dividend stocks when they go ex-dividend by week. And you can see the problem here is there are only 3 stocks that go ex-dividend in those first and second weeks. By comparison, there are a lot of great alternatives to pick from in that last 2 weeks, like LTC Properties and PennantPark, ticker PFLT, in the third week, or Realty Income, ticker O, and Prospect Capital, ticker PSEC, in that last week. But we're limited in those first 2 weeks if you want to plan out that weekly cash flow. I'm going to show you a way around this, a way to get even higher yields, but I did look at some of those alternatives like Whitestone REIT, ticker WSR, or Apple Hospitality, ticker APLE, for that first week. While Whitestone has done well on its price returns over the last few years, it only pays a 3.9% yield, which barely qualifies as a dividend stock in my book. And while Apple Hospitality offers marginally higher 6.6% dividend, it's still under Main Street and hasn't produced the price return of the BDC stock. I went with Sabine Royalty in our previous video, but with Armor and that higher dividend yield for this one. But for those that want a little bit more stability and dividend safety, Sabine is still probably the safer bet, so we do have 2 good choices in our second week dividends. And of course, we've got a lot of other choices for the remaining 2 weeks of the month, or I also like Gladstone Investment, ticker GAIN, for the third week, and maybe Stag Industrial, ticker STAG, for the fourth week. But here, opening your search up to monthly dividend ETFs not only helps give you more dividend choices in that first week, but also higher yields. I've added 6 top monthly dividend funds along with their dividend yield in red for each week they go ex-dividend. The Global X Super Dividend ETF, the SDIV, may offer the higher yield at 11.6%, but also has lost 55% of its value over the last 5 years. Instead, this JP Morgan Income ETF, ticker JEPQ, is up 10% since its inception, adding to the 9.3% dividend yield. This fund is similar to the QYLD with that focus on NASDAQ 100 indexes, but with the expertise of JP Morgan managers. The JEPQ has produced a 20% annualized return over the fund's 2-year life. The JEPQ is also going to be holding those stocks in the NASDAQ 100 index, the tech-heavy group of stocks, and selling call options against them to create that monthly dividend income. Now here, it's up to you though. If you want that highest dividend yield possible, then you might still go with the SDIV for that first week stock. Otherwise, I would go with the JEPQ or maybe Main Street for that balance between price return and dividends. Even with plenty of choices for our third and fourth week dividend stocks, you still might consider the KBWD with its 12% yield, Or one of my favorites, the Volatility Premium ETF, ticker SVOL, with its 16.5% dividend. With the SVOL, you not only get that higher dividend yield, but also the benefit of adding a different asset class apart from stocks to your portfolio, so a little more safety in diversification. And with enough of these high-yield dividend stocks, even the ones that only pay every 3 months, you're going to start to build a portfolio that constantly cash flows to pay the bills. Click on the video to the right to see the one dividend stock every investor needs to own, the top dividend paying stock of 4,700 stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.